You know, some chart patterns are nice and tidy, predictable even. Well, this is not one of them. Today, we're jumping into the broadening bottom, a pattern that honestly looks like pure market chaos, but might just be signaling a huge reversal ahead.
So you look at this, and what do you see? It kind of looks like a megaphone, right? Just blaring market noise with prices swinging wider and wider. This is literally a picture of volatility exploding as buyers and sellers get into a huge disagreement. But for a smart trader, what's the signal hiding in all that noise?
So here's how we're going to tackle this. First, we'll get a handle on this megaphone idea and break down its anatomy so you know exactly what you're looking for. Then we'll get into the numbers, how it really performs, and some surprising things the data tells us. And we'll wrap it all up with a practical playbook for how you might trade it.
All right, let's officially meet this pattern. The reason the broadening bottom gets that megaphone shape is because both the buyers and the sellers are getting way more aggressive. They keep pushing prices to new highs and then to new lows. It's a visual sign of a serious conflict heating up.
Okay, so here's the official by-the-book definition. Two things here are absolutely non-negotiable. One, it has to show up after a downtrend, and two, you've got to see those trend lines spreading apart, creating higher highs and lower lows. That structure is often the first clue that the bears might be losing their grip on the market.
Now, you might hear other traders talking about a perfect 5-point reversal, with exactly 3 peaks and 2 valleys touching the trend lines. But here's the thing to remember. That's just one version. The pattern is totally valid as long as that megaphone shape is clear, whether it has 5 touches or 6 or 7.
Okay, let's get practical. How do you confidently spot one of these things without getting faked out? Well, we can break it down into a really simple 5-point checklist. This should take most of the guesswork out of it for you.
So, let's walk through this together. Step 1, you've got to have a prior downtrend. Remember, this is a reversal pattern. Step 2, spot that widening megaphone shape. Step 3, draw your lines. The top one has to slope up and the bottom one has to slope down. Step 4, and this is important, make sure you have at least 2 touches on the top line and 2 on the bottom. That validates the pattern. And finally, step 5 is the trigger, a clear price breakout with a close outside the pattern.
All right, so you found a pattern and it checks all the boxes. Now for the million-dollar question, right? Does this thing actually work? This is where we stop talking theory and start looking at the cold, hard numbers from the source material.
Let's just cut right to the chase. You know how to spot one now, but how often does it actually lead to a move that you can make money on? That's the question every trader needs an answer to.
And here's a quick dose of reality. In a bear market, this pattern has a 9% break-even failure rate. What that means is that almost 1 out of every 10 times you see an upward breakout, it's going to fail to move enough to even cover your trading costs before it reverses. It's a great reminder that this is all a game of probabilities, not certainties.
Now this is where it gets really interesting. Look at the impact of the overall market. After an upward breakout, the average gain is a really solid 27% in a bull market. But notice that drops to 21% in a bear market. It's that classic idea, right? A rising tide lifts all boats. The broader market trend really matters here.
And that brings us to what is probably the single most important takeaway when it comes to performance. You have to trade with the primary trend. The data couldn't be clearer on this. You want to look for upward breakouts when you're in a bull market and downward breakouts when you're in a bear market. Trying to fight the market's overall momentum with this pattern is just a tough, uphill battle. But of course, no strategy is complete if you only look at the wins. You absolutely have to understand when and how these patterns fail. Honestly, recognizing a failed pattern is just as important as spotting a successful one.
Take a look at this chart right here. You can see it all play out. We get a broadening bottom, a breakout to the downside, and then boom, an almost immediate U-turn back up. The downward move had 0 follow-through. This is a textbook example of a failure.
So how do we define a failure in technical terms? Well, the source material gives us a hard and fast rule. If the price doesn't move more than 5% in the direction of the breakout before it reverses course, it's officially considered a failed pattern. That gives us a really clear, measurable line in the sand.
All right, now we get to my favorite part. Beyond the basics, the data reveals some really surprising and often counterintuitive factors that can give a trader a serious edge. These are the details a lot of people just plain miss.
Okay, you're probably going to want to write these down. First, the shape of the pattern matters. Tall, narrow patterns tend to do better. Second, and this one is totally backwards from what you'd think, upward breakouts actually perform better when volume is falling.
The thinking is that supply might be drawing up, making it easier for the price to climb. On the flip side, downward breakouts do better on rising volume, which shows real conviction from the sellers. And finally, a word of warning. Watch out for throwbacks. If the price breaks out and then comes back to touch the trend line, it's often a sign of weakness.
So we know how to spot it, we've checked the stats, and we've even uncovered a few surprising secrets. Now what? Let's put it all together and build a practical playbook for trading this thing.
One of the most common tactics traders use to project how far the price might go after a breakout is a pretty simple calculation called the measure rule.
Here's how it works. You find the highest high and the lowest low within the entire pattern, and that gives you its total height. For an upward breakout, you add that height to the highest high to get a price target. For a downward breakout, you just subtract that height from the lowest low. It's just simple arithmetic.
Let's see it in action on this chart. It makes it way easier to understand. You take the price at the highest peak, that's point A, and you subtract the price at the lowest valley, point B. That difference is your height. In this case, it's a downward breakout, so we then subtract that height from point B to get our projected price target.
But, and this is a big but, how reliable is this rule? Well, the data shows it's all over the place. In a bull market, an upward breakout hits its target almost 60% of the time, which isn't bad. But look at a downward breakout in a bear market. That success rate plummets to just 31%. The source material itself calls this dismal, which tells you everything you need to know. This rule is a rough estimate, at best.
Okay, let's wrap this all up with a few key tactical reminders. First, please, treat the measure rule as a rough guide, not a guarantee. Second, always use stop-loss orders to manage your risk if the pattern fails. And here's one last pro tip from the data. Sometimes, if the price fails to reach the opposite trend line inside the pattern, they call it a partial rise or partial decline, that can be a pretty strong hint about which way the final breakout is going to go.
So in the end, the broadening bottom is not a crystal ball. It doesn't predict the future. It's more like a map of market psychology, a picture of indecision and escalating conflict. It tells you that a big battle is underway. So the real question for you is, with this information, how are you going to choose to navigate it?